Embark on a journey of personalized investment, where wisdom guides your path. Asset allocation is your compass, dividing investments among stocks, bonds, and possibly other asset classes, balancing risk and reward. Strategic allocation sets long-term goals, while tactical allocation seizes market opportunities. Diversification is your shield, spreading investments to reduce risk, a harmony of sectors, industries, and regions. Risk tolerance, your inner compass, aligns with your comfort with potential ups and downs. Time horizon, the expected length of your investment journey, shapes your strategy, allowing aggressive or conservative approaches. Crafting your investment strategy is an art, a dance of understanding goals, seeking professional guidance, and ongoing monitoring. It's a path to financial enlightenment, a personal map to your dreams. Yes, I'm curious to hear how everybody falls on staying fully invested or having a tactical element. It sounds like it depends on one's investment horizon and ultimately your objectives. Michael, you run several tactical ETFs. Can you talk a little bit about your current allocation and how you arrive at that current asset allocation?
Yeah, okay. So this is actually, I think, a very nuanced topic. So there's passive, right? And then there's active. Active is tactical in terms of trying to look for opportunities, and passive basically says, I'm just going to sit and wait and things will come my way eventually. Okay, now, I don't view the two as being mutually exclusive. So in other words, I actually think that passive works very well with active. Blending them is another form of diversification. Now, why is that important? In a cycle like the last 10 years, being tactical hasn't really worked. Okay. And I don't mean being tactical by being in the FANG names or the NVIDIA names or anything like that. I'm talking about asset allocation broadly. Hasn't really worked from a tactical perspective because, as I mentioned earlier, emerging markets have gone nowhere for over a decade. Europe has gone nowhere for over a decade. Bonds have had essentially gone nowhere after the sell-off that we saw starting last year. So it's been actually very much a passive world, right? In terms of just go into U.S. large caps and that's it. Now, when you think about something that's active and tactical, the risk for something that's active and tactical is that you're in a cycle where you get whipsawed, where your tactical allocations just are not working. The cycle doesn't favor that opportunity set. Best way to diversify that is to have something that doesn't have whipsaw risk, which is passive, right? Now, if you are in a stage of your life where you're closer to retirement and you've got to be concerned about the possibility of outliving your assets, you need to diversify like crazy, because the last thing you want to be is all in on passive, just as a lost decade might be about to hit. So diversification, just to kind of wrap up the point, is more than just a mixture of asset classes. It's more than just a mixture of stocks. It's really a mixture of strategies. Right now, I have very active tactical strategies. I'm the first one to say it very publicly as an entrepreneur. My strategies haven't done that well because they rely on treasuries from a tactical defensive position, and that's been a very, very painful type of whipsaw the last 2 years. Maybe the next 2 years will be different. I don't know, but I don't think they're mutually exclusive.
And Andy, if I could just kind of dovetail a little bit off of what he was saying, I think it's a really relevant point for investors to consider, because so many times people think about diversification. All they're thinking in terms of asset allocation is like, what's the mix I should have of stocks, bonds, cash, or potentially other securities. Maybe they might be thinking about branching out, real estate, commodities, currencies. They may think of other things. But it's really about going beyond, as he mentioned, the kind of just pure looking at asset classes. So he was talking about, in particular, active versus passive in terms of strategy, right? And I think some of the core elements that hits upon is when you're thinking about diversification, you have to also think geographic diversification. Like, how much exposure do you have to emerging markets, or to, is your portfolio just completely North American driven, that kind of thing. So that's an element of diversification that you should consider. You got to look at the size of the securities that you're purchasing as well. Is everything large cap? Do you have any small cap or mid cap securities in there as well? That's another element of diversification as well. So too often, the bottom line is that people get locked into just thinking about one metric or one frame of reference for diversification, when really there are many broad, measures of diversification. And as a whole, we know that asset allocation is really going to determine about 90% of your portfolio's performance. So it is important to kind of get it right. You have bumps and things along the way. But I think it's about approaching it from the mindset of saying, what's the true definition of diversification in terms of how, my own risk tolerance, again, my time frame, et cetera, and then constructing a portfolio to match those needs and goals.
I would add real quick that I always make it a point that diversification by definition means having things in your portfolio that you hate, right? Because what are you going to hate in your portfolio? The stuff that's not working. Well, if it's not working, it's not correlated. If it's not correlated, it's diversified, right? So, and I think it's very hard for people to just kind of wrap their minds around the idea that the last thing you want is everything in your portfolio working, because it might work for now, but then there's another side to that.
Absolutely.
Yeah, and even on top of that, if you're right, asset allocation means you always have things that you don't like. But it also means that as you're rebalancing, you're selling the things you want to buy more of, and you're buying the things that you would rather sell because you're trying to rebalance to whatever that target allocation is. My tact with asset allocation comes down to what is the ultimate intent of what we're doing. Because I personally think that asset allocation is way over talked about and way over thought about, especially if we're talking about the fundamentals of investing. If you're trying to invest for accumulation, really, I just want to build wealth for some time in the future, and I have very long time frames. The key is just to have one asset allocation that's globally diversified, in my opinion, control expenses, control taxes, and rebalance and never look at it. It's so much because really the opportunity when you're in the wealth accumulation stage is, and I saw this, I started in the industry in 1990, right at the beginning of the big tech bubble. And at that time, the economy was different, and now it's not. Now it's different again. What has happened with investing, especially with the mass media coming on board, is that investing is seen by many people as how you create wealth. All the investment strategies and tactics that are out there, I think if you ask most people about investing, it's, well, how you create wealth. And I think that's a fundamental misconception of what investing actually is. Going back hundreds of years, investing wasn't about, especially investing in public markets like we're talking about, wasn't about in creating wealth. It was about taking the wealth that we've created through our industry, whether that's through a business that you've owned or through your savings, which is essentially excess wealth over the money you spend, taking that wealth and putting it into something that can grow over a long period of time. And I think it's really important that we keep investing in its place into asset allocation, put money into an allocation, have it reasonable fees, rebalance, and go about the business of building wealth, which is really going to be through your work and through your industry. And if you try to make investing about creating wealth, that's when you can really get yourself into trouble.
Well, I think that the financial services industry likes to make things very complex. There are 100-page prospectuses for mutual funds or annuity products. My approach in being an investment advisor, financial advisor for 25 years, I think it can be simplified when Roger's talking about accumulation. If you just own company stocks that have earnings growth, that earnings growth should drive the stock price higher over time. There should be a correlation. And even if you just invest in the S&P 500, that you don't want to pick individual stocks, the S&P 500 earnings have grown over time. And they bring in new companies and they take out old companies. So again, if you just own the S&P 500, you can, the earnings are growing, the price should follow. I'm wondering, for the panelists, you talked about rebalancing, and you end up buying things that you don't like and hopefully selling the things that ran up and you do like. So you're trying to manage your emotions a little bit. But is it good enough just to follow that, like looking for underperformers and rebalancing so that you own more? Or does one have to think about, like, the last 30, 40 years has been a bull market for bonds as interest rates went to near zero. Then in the last year plus a little bit, we've seen that reverse. Does it change? Like,
I think Andy, it depends on your time frame. Like for the people that we talk to on my podcast and with the families that I walk life with, is extremely important because their time frame is compressed, right? If you have a 60-year-old, sure, they may live until they're 90 and you have a 30-year time frame, but it's really not that long because it's the early part, because you're in the distribution phase where the sequencing of returns is really dangerous. Now, if you're like my kids who are 27 and 26, you don't really care. You have such a long time frame, and you know what? If you're getting bad markets for the first 20 years, that's probably the best thing that could happen to them, assuming that they are embracing risk and contributing consistently. So a lot of this has to do with the time frame that the money has a purpose for.
And I think also, Andy, how I would answer your question is probably not what some people want to hear, but I do think a lot of this needs to be reduced down to kind of a very simple form for people. You were talking about Wall Street likes to make things very complex and opaque and whatnot. Totally true. I mentioned, of course, the first stock that I bought was from Dow Jones and Company Inc. when I worked for Dow Jones, which was the parent company of Wall Street Journal, Dow Jones Newswires, et cetera. And when I covered, Wall Street on the beat, as we called it, on my area of coverage, broke it up with another guy, Mike Santoli. You see him on CNBC all the time now, as I later went to CNBC as well. But I covered like the people of Wall Street, right? And, kind of the deal making side. And Mike covered the product side. And we used to always laugh about like this kind of, Frankenstein alchemy kind of thing that these guys could come up with. There were MIPS and PERKs and DEX and CUBS and, a couple of other acronyms that I forget. And it was just like, not to get into all kind of, derivatives of all kind, et cetera. So for the average investor, for the person who's, trying to reach goals that are very actually simple, like, okay, 15 years from now, I want to pay for my kid's college education because my kid is 3 years old and they're going to be going off to college when they're 18. Or like Roger mentioned, I'm 60. I want my money to last. Maybe it has to last 30 years or so, that kind of thing. So I think that to the extent that we can kind of simplify a little bit of what this looks like, I will quibble if I can with one thing that Roger said that I just personally disagree with. It's not a really a strong knock. It's just an observation about human nature and human behavior. So I do agree where he said, kind of like set it and forget it, right? Because sometimes we're our own worst enemies. And, the more people get, involved and they panic, they get fearful, they get greedy, they do all kinds of things. And I'm sure as advisors, you guys have to like talk them off the ledge quite a bit. But I have noticed for many people that kind of risk of set it and forget it as well, where they're not rebalancing, where they're not taking a look at and seeing how they have portfolio overlap now, or how they are duplicating their investments and things have gotten, out of control, and, a certain sector or a certain given securities might comprise a much larger percentage of their portfolio than they anticipated. So I think
I think that's a great point, Lynette. I think that's a great point. I call it the financial industrial complex is alive and well.
Yes.
It is a cabal that wants to create things for us to buy and sell us.
Yes, very much so.
And I agree with you. I think from a foundational standpoint, and Michael probably would disagree with this, but a static asset allocation that's dynamically rebalancing to a set allocation from a fundamental standpoint is not really it's not a bad way to go. And, my attitude with investing is it's sort of like my attitude with food. I want to eat food. I don't want to eat food product. And the more I don't understand the ingredients, the more I probably shouldn't eat it or invest in it.
Yes.
I want to eat, but I'm fasting. So I for me, the eating is important, but I'm trying to do this fasting thing. Real quick before I drop just a little food for thought. This narrative of a cycle now where bonds are forever dead, that the last 40 years that bond bull market's over, and that's why from an asset allocation perspective you should underweight bonds, to me doesn't make sense. The bond bull market cannot end unless the government spending binge ends, because everything that the government does is debt. So I caution against narratives. I think for me the biggest thing for any investor, retail, professional, whatever it be, is question narratives which follow price. The narrative that the bond market is dead, that the 40-year bond bull market is dead. I'm sorry. The only way you kill a bond bull market is with austerity. Good luck.
Michael, before you go, since this is investing 101, many people, they're thrust into their first investing is often through a 401k plan at work. They're looking at a menu of investment options. Should they go for a target date fund, or should they select? And then I think the discussion goes forward, because one has to manage that ongoing through their career. And I don't think any of us got the training, how do you manage your 401k? So most people are always confused. What should they do?
So
target date fund or no?
So we said food and we said menu. So you're killing me.
Are you fasting? Is that what's going on here?
Yeah, exactly. No, but actually, I actually think target date funds make sense for the vast majority of people, because if you don't have any real education, it's an easy way to sort of kind of set it and forget it, because it's based on some date in the future. It may also be suboptimal. There's a lot of studies that show that target date rebalancing, depending upon when the rebalancing occurs, can actually have less returns. The rebalancing thing is 100% valid, but there's so many nuances in terms of the interval and frequency that can result in very different return patterns over time. But yeah, probably target date funds make sense. And the reality is advisors make sense. Look, the most people can do asset allocation on their own with a little bit of research. But the reality is most people don't know themselves. They don't know how markets work from a perspective of longer term history. And that's where the role of an advisor comes in, to not just talk somebody off a ledge, but help walk them to the next stop, right? So I don't think the advisor community will ever be fully automated away. As long as people still want to be handheld, which they always will be, no amount of GPUs will replace what we do.
That is good for us in the business, whether you're a money coach or a financial advisor or managing an ETF. So thank you. Let's shift toward budgeting, and we'll go to segment 3.